I think it's already past the recording. I think recording is ongoing. We are not stopping.
No, I stopped it. Now I have started again. Hello all. Very good afternoon to everyone. Thank you for all joining for this exclusive webinar on income tax for financial year 24-25. Since you all know we are just few months away from the July 31st deadline, I think this session is designed to help you understand the latest updates and what are the mistakes we can avoid while doing the ITR submissions. We are fortunate to have both CA Shraddha and Chaitanya Kumar, CA Chaitanya Kumar here with us today for their experience of tax consultancy. And they're going to help us through the complaints and key things the taxpayer should know for this season. And of course, we'll also have the question answer session at the end of the webinar so that you can feel free to ask questions to us. Thank you. Over to you, ma'am.
Thank you, Akash, for your wonderful introduction. First and foremost, I welcome all of you for this webinar series. Every month we have been organizing from Coral Metrics. It's more like an awareness series and also to educate our clients and also all the taxpayers when it comes to direct tax and indirect tax. Now, currently we are in the April month, so we thought it's a right time for us to get to know more about income tax. Many taxpayers have been filing their tax returns regularly for years, but still our Honorable Finance Minister is making the every year very interesting and new because of recent changes and amendments in the taxation laws and as well as the filing formalities. So we thought it's a right time to conduct a webinar in this regard so that you will be better known about the provisions as well as better complied with the laws. This is going to help you in correctly reporting your income as well as stay as a compliant citizens. So with this note, let me present today's session along with me, Chaitanya. So feel free to raise your questions anytime. Please make note of it, put it in the chat box. Last 15 minutes will be spent towards answering your Q&As, right? Thank you so much for joining once again. So first question that comes to everyone's mind is that who has to file income tax return? Is there anything like people who have more income only needs to file? Is there any limit beyond which they are required to file? Or is it anything like compulsory to file the returns, or it's not compulsory? Even if you have more income, it's okay not to disclose or not to file. So this is the basic question which everybody gets because many of them think that if they have a PAN card, they are required to file. Some of them think that if they have a bank account and interest income, they are required to file. So let's understand, if you are a taxpayer of below 60 years, maybe any income. When I say below 60 years, it can even be a 15 year. It not necessarily be a 21 years or 18 years or a minor or major is not a criteria. Any person having below 60 years of age is required to file if his income is more than 2.5 lakhs per annum. And senior citizen, as far as income tax is concerned, 60 years to 80 years is considered as a senior citizen. So when they have an income of more than 3 lakhs, it can be from any source. It can be from interest, or it can be from pension, or it can be from any other source like, sale of any mutual funds. So when the income is crossing more than 3 lakhs for a senior citizen, which is between 60 years and 80 years of age, they are required to file the income tax return. Then there is something called as super senior citizens, which Income Tax Act recognizes for any taxpayer of more than 80 years of age. They have been given relaxation up to 5 lakhs, where the taxpayer's income is up to 5 lakhs. They are not required to file any tax returns. So this is the basic of filing the tax return. But it doesn't stop here. It also says, apart from these conditions of senior citizen, individual, super senior citizens, there are certain additional criteria irrespective of the age, where age does not matter, income does not matter. So if they fall into any of these criteria, any individual needs to file their tax return. So first and foremost, with respect to the compulsory condition, I can call is that holding of foreign asset, right? So when I say yes, I would like to add Chaitanya to say a few words here. When they say holding foreign assets, right, there are certain NRIs who returned, NRIs who are NRIs in the last year, who have come to India, but they have not closed their foreign accounts in abroad. But they are Indian citizens. They do not have any income in India. They do not have any income in India, but they have a foreign account. Do they need to file their returns?
Yes, it's mandatory to file. Who, as a resident who are having the foreign assets in outside country, we need to declare in their income tax return. So these are the assets we are having in foreign assets. It may be a asset or it may be income. We need to report in the income tax return.
So income is not the criteria. Even if their foreign bank accounts do not earn any interest, still they are required to file the tax returns in India.
To file in the India.
In Indian tax return, they are required to file disclosing the assets, foreign assets. So it is compulsory for anybody, even without having any income, being a citizen or resident of India. So that's what it says. The second category is that those who have a deposit of more than 50 lakhs in a savings bank account. So in your bank deposit, many of you have a savings bank account which earns a lesser rate of interest. So any person, there is no age criteria, any person deposits, some deposit of deposit. What I mean is that he deposits a check. The source can be from anywhere. It can be from the gift, or it can be from borrowings, or it can be from anything. The minute they deposit 50 lakhs into the savings bank account, they are required to file their tax returns. And what happens when they visit their parents or their children or their relatives abroad? Even if they do not have any income, if they spend on their travel, they are also required to file their tax returns. Another thing which they have come out with recent circular is that any person who pays electricity bill of more than 1 lakh. So how is it connected? Like, when we talk about income, why are they connecting payment of electricity with filing of returns?
So actually, government, they are thinking if the electricity bill payment itself is more than 1 lakh. So they are thinking how the electricity bill payment itself is coming 1 lakh means how much they will have the income. Based on that only, they introduced this criteria for filing ITR. If the electricity bill payment itself is coming 1 lakh means that we can think that the house.
Yeah. So this is basically the income tax department collects data from various sources. One such source is from electricity department, that is from KEB, where it supplies all the data relating to any person, any consumer who has consumed or who has paid more than 1 lakh of electricity bill in a year and submit it to the income tax department. So the income tax department will analyze and check whether that list, the entire list supplied by electricity department or taxpayers, in case if there are anybody has not filed the returns from the list, there is every possibility that that person gets a notice from income tax department for non-filing of tax returns. So the basic presumption of income tax department is that when a person is capable enough to pay a 1 lakh of electricity bill, definitely there is a possibility of him owning a property which is worth some amount that may yield some income. So it will amount to non-disclosure and concealment. So we have to make sure that whoever pays an electricity bill of more than 1 lakh a year or 1 lakh a month is necessarily need to file their tax return irrespective of the income that they earn. Next criteria is that you might be knowing about TDS, where it is in Form 16A, there will be a column called TDS, and there are AAS, TAS statement, and Form 16As are issued to you. The minute you get any Form 16A, because there is Form 16A is issued where the interest income is more than 25,000 for any common man, for any person below 60 years, and TDS is deducted at 10% on interest of more than 30,000 for senior citizens. So if that being the case, when the TDS or interest is more than 25,000 or 30,000, in such case, TDS is liable. The minute you see any entry in your Form 16A or 26AS, you are required to file your income tax return irrespective of your income. So you may think that my income is less than 2,50,000. I do not have any other income. I'm falling below the threshold limit. So I don't have to file my returns. The bank has wrongly deducted, even after me submitting Form 15G or Form 15H, they have gone ahead and deducted the TDS return. But please be under the presumption that you don't have to file return. Because of the entry in the Form 26AS, you are required to file your tax returns. Then the last criteria is about business turnover.
Business turnover is the person who are doing the business. So his gross receipt or the turnover, it is exceeding 60 lakhs per year. So he need to file his income tax return. In case if he is doing any professional business, then the turnover limit is restricted to 10 lakhs. Who and all the turnover below 60 lakhs and he is getting more than 2.5 lakh income per year, he is required to file. So we need to see the turnover criteria and the profit criteria also. If the turnover criteria is below 60 lakhs and the profit is not exceeding 2,50,000 means he is not total income. It does not exceed 2,50,000 means he is not required to file. So while filing, you need to check carefully. So our turnover, if you are doing a business 60 lakhs, in case of a professional, the turnover limit is restricted to 10 lakhs.
So for a simple understanding, it is better and it is advisable for any person who's doing any business or profession. It is advisable to file their tax returns without a miss, irrespective of their turnover or profit or loss, whatever may be the case. So then comes the next question, like if we do not file our tax returns or if we miss to file our tax returns, is there any remedy? If you have missed your due date, yes, there are various returns which can be, filed with fine or penalty, whatever may be the case. But there are serious consequences if you do not file your returns at all. So first is what it comes is that you have to pay. As far as this year is concerned, financial year 2014-15 is concerned, the due date for filing income tax return is 31st of July 2025. So if you do not pay your taxes, ideally, all the taxes, as far as income tax is concerned, the income earned in that year needs to be paid, the tax corresponding to that income to be paid on or before 31st. That means 31st March of 2025. Ideally, you should have paid all your income tax payments by 31st of March 2025. Those who have missed to pay in the form of advance tax, they can continue to pay before filing the tax returns. That is before 31st of July 2025, but it comes with the interest. So when it comes to salary, it is taken care in the Form 16 itself. The employer takes care. For others, senior citizens, there is a special relaxation where they do not have to pay advance tax unless and until they have a business income. Whereas for others, whoever has not paid any taxes, advance tax, that is the total tax payable is falling short of the TDS deducted. To that extent, ideally advance tax should have been paid. If they have not paid, then it will attract interest. So non-filing of return will attract interest, and also there is a penalty and fine. Can you talk about penalty? What happens if they don't file after by 31st?
If a taxpayer has not filed the return in time, then the government has given for belated return also. In the belated return, we can file belated return also till 31st December 2025. So in belated return, government will allow the TDS credit to claim as a refund if taxpayer is eligible for refund. he can claim the refund. And the penalty depends on income. If the taxable income is below 5 lakhs, they will levy the penalty of 1,000 rupees. If the taxable income is exceeding 5 lakhs, they will levy the penalty of 5,000 rupees. You need to pay the taxes along with penalty at the time of filing. If you so after 31st March also, we can file after 31st December 2025 also, we can file a tax return by using updated return. So recently government has introduced, so with 2 years, we can file the income tax return from the end of the relevant assessment year. So if you are going to file an updated return, so they are going to levy additional penalty. It may be 25% off on additional tax payable. So apart from that, the late fee, including late fee, we need to pay additional taxes also. It depends on 25%, 50, 75% also. 75% also depends on delay.
So basically, if you look at it, there is a time limit given, due date given as 31st of July 2025. Beyond that, you can file belated return. There's you can always file a revised return provided you have filed your returns on time, that is before 31st. Over and above that, government, as rightly pointed out by Chaitanya, ITRU, they have introduced updated return. That period also, it is extended now. So there is no harm. You can always file up to 4 years, even if you miss your due date. But it comes with a huge cost. One is that your penalty, 25%, 50%, 75%, it goes on. One more important point I would like to add here is that you cannot claim refund. Assuming you have some refund to be claimed from department and you have missed your due date, 31st of July 2025, and you are missing the next due date of 31st December 2025 also, then if you go for updated filing, you cannot claim your refund. Refund is gone. So that's one pitfall in updated return. So next is that all the deductions or exemptions, there are certain key exemptions which are allowed only if you file your returns on time. Otherwise, you don't get. That will also, you will be missing. And carry forward losses, where there are 8 years of carry forward loss you can do in terms of whenever there is a capital gain. It is not only for businesses, even for a normal taxpayer who has some capital gain loss whenever he has sold any immobile property or mutual funds or any units, stocks, securities. If there are any losses arising out of those sale transactions, if he does not file the tax returns within the due date, then he misses the opportunity of carrying forward those losses. Why is it so important is that, assuming in the next year, next to next year, if he is making any profit out of any transaction, this loss cannot be offsetted. So he will miss to gain that benefit. So it's always better to file your tax returns, even if in case of any loss that arising out of sale of securities or sale of immobile property, you might have incurred a loss. That's good, but still it is going to help you for offsetting against your future profit or gains. Then what is the next about old and tax regime? And
so in case if the taxpayer is going to file the tax return in time, he has a right to choose either old tax regime or new tax regime. In case if he wanted to opt in old tax regime, he need to file the return in time. If we want to file the return after the due date, he cannot opt the old tax regime, even though if it is a more beneficial to the taxpayer. By filing the income tax return as a taxpayer, you need to check whether it is a beneficial old regime or new tax regime. So based on that, you can file the return. But if you want to opt the old tax regime, you need to file the tax return before 31st July 2025.
Yeah, so this is very important point, because in old regime, for few of them, those who have certain investments, they tend to take better advantage. So though the government has made in such a way that ideally the new regime only works for all of them, but still there are few cases where even the old regime gives a better benefit. So for those who want to avail or compare which regime to go for, it is advisable for them to file the returns on time, so that they will have the comparative and choice of selecting whichever regime they want to. So that's what is one good thing which we wanted to add. And one more thing is that, there is every possibility that getting a notice or scrutiny from department, those who do not file the tax returns. So you must be getting SMS and you must be getting emails. Government is continuously ensuring that all taxpayers are filing their tax returns on due date, and it is well advertised in through advertisement in the television and newspaper. Everywhere it is publicized. But even after all that, even after creating governments, the taxpayer who misses the due dates, they are looked at from the radar of scrutiny and tax evasion. So to avoid all such things, it's always better to file returns on time. And there is something also called as best judgment assessment. This is how it works. Assuming you have not filed your tax returns for financial year 2024-25. So the government will wait up to certain time, say up to 1 year, give you a notice that from the records we observe that you have not filed your returns. So we are giving you an opportunity to file your returns. If you ignore even that mail or communication of the department, then the department can do the best judgment. In the sense, what they will do, they will assess your financial year 2024-25 income as equal to 10% or 20% more than the previous year's financial year 2023-24's income, add on the 25% or whatever according to their judgment, and then compute the tax and serve a notice on you saying that this is the amount you, from the records we find that this is the amount which is provisionally payable to you. So there is every possibility of getting such notices. So this is also one important thing which you have to keep in mind. So I hope all of you present here are taxpayers who are filing on time. This is just to create some awareness of consequences of non-filing. Then comes the what all the things that we have to do if we have to file our tax returns on time. So there could be some first-time filers, there could be some many years filers. Now, if you see, the department is also appreciating the regular taxpayers, high taxpayers in the form of certificate in gold, silver, diamond, all that. It recognizes the taxpayers. The appreciation letters it is giving. It is a very good news for taxpayers because they feel good and elated that they are contributing something for the country. But when it comes to taxation, every year is a new year. As I informed you earlier, every tax year is a new year for us, even for the assessee, because in the last year, there is every possibility that there is a new transaction, which they wouldn't have done it in the past, either in terms of sale of immobile property or any gift or any bill or any foreign travel. Something or the other would have happened in the last financial year, which is financial year 2024-25. So first and foremost is that any taxpayer, those who want to file their returns, they have to check their residential status. So Chaitanya, can you tell me what are the different types of status for an individual?
So three types of residential status. Three types of residential status are there. One is a resident, and actually two we can tell: resident and non-resident. Resident again can be divided into two types: resident and ordinary resident. Resident but not ordinary resident. It depends on number of days stayed in India. Based on that, we can choose which will fall under this criteria. For you, if you want to satisfy resident and ordinary status, you need to satisfy with he is in India 180 days or more during the previous year, or he is in India 60 days or more and 365 days or more preceding to for previous year. Then he will get a status of resident. And there is a subsequent conditions also. So he need to satisfy the subsequent conditions for getting the resident and ordinary resident status. What are the subsequent conditions? He has to satisfy the 2 years out of the past 10 preceding previous year as a resident. And he is stayed in India 730 days or more preceding 7 years. Then if these two conditions are satisfied, then he will get a status of ordinary resident. Based on this number of days stayed in India, we can choose whether he is a resident in India or non-resident in India. So based on at the time of IT filing, we need to choose carefully which status we will fall. So based on that, income will vary. So for resident, entire income, global income will be taxable. For resident, but not ordinary resident, only some income only is taxable. For non-resident, only foreign income only is, Indian income only is taxable.
So this is a very good point which he highlighted, because there are citizens who stayed in US or any other foreign country. They would have returned back to India, so they enjoy the status of resident but not ordinarily resident. They are not called as resident the minute they come back to India, and they do not enjoy the status of non-resident also. So it is very important for us to calculate the number of days of stay in that particular financial year to arrive at his residential status. Once when we arrive at the residential status, then the complete gamut of income tax itself changes. For if he is a non-resident, then the tax, what are the source of income which are liable for tax, and the rate of tax, and also the reporting formalities with respect to foreign assets, and also one more important thing, the choosing of the correct ITR also varies. So these are some of the things which we have to be very careful while choosing the residential status. If you look at many of them do not pay attention to the residential status. We see that while coming to India, many years they are non-residents, but they do not report their residential status to the bank. They still continue the normal savings account. They do not move it to NRO or NRE, whatever. They may say that bank, we have submitted to the bank, but bank has not taken any action. But when it comes to any penal consequences, it is the responsibility of the citizen to ensure that they report it, document it, and highlight it to the banker. Otherwise, there are not only monetary penalty, there are other consequences also. So it's very important that you have to keep track of your residential status correctly. Then when it comes to the next step, now that we are in the second week of April, now itself you should start collating what are the types of income you have, what are the various sources. Just scan through your bank statement. You will come to know those who are paying any property tax, if they have any rental income, they have to make sure that they keep the property tax intact and then collect the rental receipt. Whatever it is needed for your source of income, you have to organize and keep it ready. Then one more important thing when it comes to portal, the portal is excellently designed, and it is very quite easy as well. Many of them are filing on their own, unless and until there is any complication in terms of filing or understanding the provisions, they file it themselves, which is very good practice. But having said that, if you want any clarity, do not file something with your wrong understanding, because disclosure of wrong income under wrong head may lead to penal consequences. So if you are not clear about your income, though it may be auto-populated, they have made it in such a way that all your income, say if you are a salaried employee, the minute you click on your ITR1, all the figures get auto-populated. All you need to do is just press next button. In third click, you get a submit button, you submit it, and then OTP comes, your filing gets over. But it's not simple as you think. It may look simple, it is simple, but you please ensure that you do not get into the zone of non-disclosure, because non-disclosure of certain income or non-disclosure of certain receipt, it not necessarily be an income. There could be some exempted income, which government may not know, which will not come under the auto-populated return. So you have to be careful. So when whenever you have any kind of exceptional entries or exceptional transactions in the previous year, just don't blindly go by the portal. You approach a professional, take somebody's help, and then upload your returns. Because certain cases, if you cross certain period, you cannot revise your return. Once filed is filed, and that too, if it is processed, you cannot do anything. Then the only way to rectify beyond certain period is through only if any notice is served on you. So you have to take due care. And one more thing is that whenever you are filing your opening your login, opening your e-portal, income tax portal, make sure that all your personal details are correct, whether your Aadhaar is linked with PAN, and your mobile number, email address, everything is updated. There are cases where they would have given the email ID or mobile number of their relatives or friends or tax consultants or somebody else, other details. But make sure that everything belongs to you. You keep it safely. It is always a good practice to change your password and keep it safe. And whenever you forget, there is always an option to reset it. It will come to your registered email ID and mobile number. So these are some of the points which you have to keep in mind before you attempting to file returns on your own or whenever you approach a chartered accountant for help. Anything you want to add, Chaitanya, here?
So same thing. So apart from that, you need to check whether the reported income is correct in the portal or not. If the reported income is vary from your income, then there is an option feedback. If the income is not belong to you, then you can disagree that income and you can file with the corrected income. So in the now ASTS is giving incorrect information also, so that you check before once you are filing whether that income is correctly reported or not. Sometimes they will report short income also, even though we are getting more income. So we need to report correct income.
Yeah, very good point. I would like to add something a little bit more here. So when it comes to, when I said auto-populated, the auto-populated return is pulled out from your AAS and TAS record. AAS and TAS records are nothing but it is from the source document, which is, say, for example, if you have 4 bank accounts and 4 banks you have fixed deposits, all the 4 banks would have updated the interest earned by you to the income tax portal. That is what is getting reflected in the AAS, TAS. So when out of those 4 banks, 3 banks would have reported on time. Okay, there is every possibility that one bank, out of 4 banks that you have, one bank, either they are delayedly reporting or not reported one of the transactions. So when at the time of you filing the returns, there is every possibility that obviously if only 3 banks have uploaded, only the similar same thing only will get uploaded in your popped up in your ITR also. So there is a possibility that you also end up missing interest earned from the 4th bank. Assuming you have blindly understood only the 3 and go by the data driven by the system, then you have also uploaded. What happens at a later point of time, the 4th bank realizes that they have filed it, they have to file certain returns or they have missed out. Then in such case, they will be uploading the data relating to you at a later stage. So you, after filing your returns, that report will get updated in your AAS, TAS. So because of that, at the time of processing by the income tax department, it can be at any time, maybe 2 months, 3 months, or any time, it will throw a variance report in the income tax portal. So you will be served a notice saying that you have not disclosed. You have disclosed correctly whatever was uploaded at that point, updated at that point of time while you are filing the return. But later the 4th bank has updated the record. That is definitely not your fault. But having said that, you cannot blindly follow what was there in the income tax portal. It is your responsibility to ensure that you had 4 banks. Out of the 4, only 3 are reported. 4th bank, voluntarily, you have to either prompt the bank or 4th bank, or you have to disclose in your income tax return. So the responsibility of disclosure is in your hands. The whatever the auto-populated or data-driven or already available records are only for reference purpose. It cannot be taken as a conclusive evidence of your income. Right? So this is one part. Second is that, as rightly said by Chaitanya, there is a possibility that somebody else's record is reported, someone else's income is reported against your PAN. There is every possibility. I am not saying that all banks will do. There is every likely. It is not only bank, it can be from anybody. The employer may report, or any other travel agent may report, or it can come from any sale transaction. It can be from any source, any point. It is, if it is, unfortunately, if it is reported against your PAN, it is somebody else's income is reported against your PAN, then you have to take due care. even if you omit, like thinking that it is not yours, you know that it is not, assuming, let us take an example of purchase of car, right? You have not purchased any car in the last financial year, but against your PAN, there is a transaction which is appearing in the Form 26AS. You know that it is wrong, so you have ignored that and uploaded your return. But the income tax department will send you a notice saying that you have missed out that transaction. So you have to disprove. So instead of waiting for that, as rightly said by Chaitanya, you have to report saying this income, this transaction does not belong to me. You have to deny instead of accepting or ignoring. So corrective action before any notice prompted from the department is very critical here. Right? So we will move on to the next step. Now that you are very clear about the income tax portal, what are the sources you have to, what are the income you have in mind as far as you are concerned. But even otherwise, it is very important to understand what are the various heads of income, right? Yeah.
So there are total 5 sources of income. So everyone, the salary income, income from house property, and the profits and gains of business or profession, and capital gain. So which one will not fall on above 4 categories, it will fall under the income from other sources. Example, income from tuition fee. So that interest income, dividend income, those and all, there is no specific head. That's why they introduced this class, income from other sources. So based on the income, so you need to select the proper ITR. So based on that ITR form also, it will get varied. So for example, if you have a salary income, the respective taxes will be taken care by the employer. He will only deduct the TDS amount at the time of giving salary. So whereas when come to income from house property, so whatever rental income you are getting from the tenant, you need to declare in your ITR. So based on that, tax will arise. So we need to pay the tax in the form of self-assessment tax or advance tax. In the profits and gains of business or profession also, we need to calculate the tax on how much profit will arrive in the current year. Based on that, you need to pay the taxes in the form of advance taxes. The capital gain only it will come when there is a sale of capital asset. If there is no sale of capital gain, if there is no sale of capital asset, this concept it will not come. So you need to choose whether any asset sold during the year capital asset, those transactions all you need to declare in the ITR. Income from other sources, these which one will not fall under above all 4 categories, you need to declare here. Example, as I told, dividend received from the companies and tuition fees, so family pension, interest income, etc.
Any gift from non-relative. It can be anything, right?
It can be anything.
So Chaitanya is my friend. If I give him 1 lakh, so he's supposed to disclose it. Though it may not be his income. It's a gift, but still I give him as a gift, but he cannot accept because he is not my relative. He does not come under the definition of relative as far as income tax is concerned.
So these 4 categories, it will not fall. So that we need to report in the income from other sources that this is the gift amount we received from the so-and-so person during the year. Non-disclose of this income, the future income tax department, they will levy penalty. It's 100% or 200%, depends on misreporting or under-reporting of income.
So over and above that, there is a last category, though it does not fall under the main heads of income, because it is categorically it is decided from beginning of our human nature. I should say that agriculture activity, any operations, any income, any profit that derive from agriculture operation is exempted, but still we have to examine whether that activity falls within the definition of agriculture. If you have any agriculture income from any farmhouse or any other activity from out of your labor or your relatives or under the definition of agriculture income, it is important for you to disclose it. It may not be taxable, but it's very important for you to keep the records and disclose it in your income tax return. Next is that how do I, now that I know I have understood what is my income, what are the different types of income, how do I look into the portal? What are the consequences of non-filing? Yes, I know I have to file. I have understood my residential status. But how do I know which is the right ITR for me, correct ITR for me? Because there are various numbers, ITR 1, 2, yes.
So
How many?
there are total 7 types of ITR. So when you are filing, you need to check which ITR you need to choose. It is purely depends on the residential status, source of income, and the total income, nature of business or profession, ownership of the asset. As simply, you cannot select ITR 1 for all the income. If you are having all income, depends on income, you need to select the ITR. Those and all we will discuss in this session only. Next slide.
Yeah.
So ITR 1, actually ITR 1, if you are having any salary income and only one house property and other sources income, then you need to select the ITR 1. And the income from salary is restricted to 50 lakhs. If you are getting income from salary, gross total income is about 50 lakhs, then you cannot select the ITR 1. ITR 2, so if as a NRI, you can select the ITR 2, which and all will not fall the ITR 1, 3, 4, you need to select the ITR 2. It may have, if you are having a salary income and you are having a director in any other company, and if you have a capital gain income, then you need to select the ITR 2. ITR 3, it will come into the picture only if you are having a business income. If you have any income from business or profession, you need to select ITR 3. So ITR 4, if you are having a business income and you are opting the presumptive taxation. So there is a difference between the presumptive and not opting the presumptive. If you are going to presumptive taxation, then you need to select the ITR 4. Even though you are carrying a profession and you are offering the income for taxation as a presumptive basis, you need to select ITR 4. So ITR 3, if you are maintaining the proper books of accounts, you need to select the ITR 3. In ITR 4, not required to maintain the books of account, provided that limit is, it should not cross the limit given by the income tax department. So ITR 5, so it is applicable other than individuals. So individual can choose ITR 1, 2, 3, 4. Individual cannot choose the ITR 5, 6, 7. ITR 5 is applicable only for firms, LLPs, association of persons, body of individual, and artificial judicial person. ITR 6 exclusively for companies. It may be a private limited company or public limited company. Any company, ITR 6 has to choose. ITR 7, trust. If the trust is a registered trust, it has to choose the ITR 7. Political parties, news agencies, universities, etc. Those who fall in this category, they need to choose ITR 7. So we are discussing about individuals. So be careful which ITR you need to select. ITR 1, 2, 3, 4 based on your income. You need to select ITR 1, 2, 3, 4, not ITR 5, 6, 7.
So when it comes to auto-populated, whether all the returns are getting auto-populated or only few? Only few.
Only few incomes.
No, when a return ITR 1, it's auto-populated, whereas ITR 2 or 3 are not auto-populated, right?
Correct.
So only this auto-population facility also has come only to ITR 1.
ITR 1 only.
So when you have a simple salary income, then and TDS is also deducted, then only you get to file the auto-populated return. Otherwise, you will end up assuming somebody is working in a private limited company and they do not have taxable income. Say TDS is not deducted after all deductions. TDS is not deducted after exemptions and basic, deductions and insurance and other PF and other stuff. If that being the case, they will not be giving a formal Form 16 or TDS would not have been deducted. In such cases, there will not be any record auto-populated coming out even for ITR 1. So when you say that ITR 1 is simple and it is auto-populated, it is not true. Wherever there are records are already updated in the income tax portal, only that will get auto-populated in your ITR 1. Otherwise, no. Only the basic fields will be auto-populated. Say your name, address, basic details only will get mobile number. So incomes and all that will not get auto-populated.
Example, in ITR 3 also, government know only our turnover. They doesn't know our expenditure. So when we are selecting ITR 3, you need to maintain the proper books of account and fill the data as per the records maintained by you. These details and all we need to fill at the time of IT filing and choose the proper form.
Correct. So when he says business income, in the ITR, you can, whenever you are filing, somebody is liable for GST, the turnover that is reported in the GST return gets auto-populated in the income tax return form 26AS also. So what he means is that turnover only comes, but not the profit or anything else. So what you have to report in the, what is getting taxed is not turnover, it's only the profit. So again, you have to maintain books of accounts. So basically what I'm trying to drive here is that though it is called as auto-populated, you will end up filling and validating the data that is getting auto-populated from the website. Next is that this is a common question for many taxpayers. Which scheme should I opt for? Okay, the first week of April, this is a common question from many of the salaried employees, because the employer is asking them to choose and upfront declare, should it go for old tax regime or new tax regime? Let me spend 1 minute of time here, because when government introduced this scheme, old and new tax regime about 2 years ago, basically they wanted to slowly withdraw the exemptions and all the deductions one by one. Many of the taxpayers were making the investments only to save taxes. Say, for example, they used to invest in insurance policies. They used to invest in ELSS schemes, mutual fund ELSS schemes, just for the sake of saving tax. PPF had some exemption and PF had some exemption. So because to avail the tax benefit, the taxpayers were choosing, otherwise they were not investing. So what the government thought, let us reduce the tax rate, make it comparative, make it competitive in such a way that the employee takes home more salary instead of paying taxes. At the same time, he diversifies his investment in whatever form he wants to. Assuming the stock market or any other market gives a business, for that matter, gives more returns than government secured securities or fixed rate of interest on fixed deposits given by scheduled banks, let the taxpayer choose the way how he wants. Let him not block the entire money just to save tax and end up getting lower interest by blocking his money in the government securities. So with this intent, they wanted to grow the economy. So they came out with the scheme which balances the tax, which balances the savings, at the same time brings more take-home salary for the take-home income for the taxpayer. So with that intent, they introduced the tax regime, new tax regime, and it was informed earlier that by our Honorable Finance Minister that slowly this will get faded away and there will be only one tax regime. But unfortunately or fortunately, we are having this regime for the past 2-3 years. 24-25 also continues. So, but if you look at it, majority of the taxpayers, it is designed in such a way that new tax regime only is giving the ultimate benefit as compared to the old tax regime. But still, you have to have some kind of planning. You can choose anything you want to, like old or new. You can choose new. Later on, you can go for old also at the time of filing tax returns. So upfront, you don't have to block. Like what I mean is, assuming in the beginning of the financial year, if an employer is asking you to commit which tax regime you want to go for, you can say new tax regime. And then at the time of filing the returns, we are here to evaluate which is beneficial for you considering the other incomes. So if you feel that if we advise that new tax regime, old tax regime is going to give you better benefit, you can always change it, shift it from old to new, new to old, anything you want to. But it comes with a caveat. It is not applicable, this shifting of old and new, it's not applicable for all taxpayers, right? It is only for salaried taxpayers. It's not for business income. So when somebody is having a business income and he is having other tax saving investments, he has to have a proper tax planning, because once he opts for old tax regime, then moving on to the new tax regime is once. again switching back to old tax regime, again switching to a new tax regime is not possible. He has to stay in the regime for a committed period of 5 years. So before that, he cannot be shifting back and forth. So he has to be consistent while choosing the tax regime. So these are some of the things which we thought when it comes to tax regime, a taxpayer should keep in mind. And this is for your reference. You can always download. We will be sharing this PPT with you, and it will always be available in our channel also. You can download it. So this is the summary of new tax regime and the old tax regime. And some of the best practices we thought we will share it and then leave the floor open for Q&A. First and foremost is that first assess your income on real-time basis. The meaning by real-time basis is that every quarter you please have a check, because in a year there are 4 installments of advance tax payments. If you feel that if you have done any transaction of sale of securities, sale of mutual funds in first quarter, you ensure that you pay your advance tax to that extent or in full in that quarter itself. Otherwise, you will end up paying interest. So always plan your taxes, plan your advance tax, pay your advance taxes in the correct installments. And whenever you come across any transaction which are very confusing for you, consult a professional so that they are able to advise you on the right taxes at the right time. Always file your taxes on time. Do not delay, because we mentioned about the consequences of delayed filing and non-filing. And even while making the payment, please take due care, because once if you choose the wrong financial year or assessment year, this confusion also many of us will have, whether it is assessment year or financial year. If you make any mistake while making the advance tax payment or self-assessment tax payment through a challan, ITNS 280 or 281, whatever, it is very difficult to change the challan, change the nature of payment, change the code. So it is you have to be very, very cautious, and it is critical for you to pay the taxes under the right head, whether interest or tax or year or selection of income. You have to take extra caution while paying the online payment. And also, you please check your e-portal and make sure that your payment is offset against your tax dues. Some of them have paid and then left it. They have failed to link the tax paid challan along with the tax dues while filing their returns. So because that is not an auto-populated, it has to be manually keyed in, or you have to wait for some time after making the payment. So these are some of the best practices which you have to follow. And some of the errors out of our experience, we felt that some of the taxpayers, knowingly or unknowingly, they fail to disclose the savings bank interest. They think that on savings bank interest, there is no TDS, so there is no tax. It's not so. Savings bank interest also attracts tax. So you have to disclose. So saying that I was not aware, there's no excuse if you're not knowing the law. And you have to download your ASTAS and check and cross verify. And rental income also, you have to disclose it very correctly, because some of them may own a joint property and they would have given the first PAN holder's name to the tenant. So TDS would have got deducted in the second joint holder of property. So various combinations they would have done. But as far as law is concerned, if the property is in dual name, necessarily it has to be disclosed in the income arising out of the property should also be disclosed in the dual joint names, 50-50 or whatever as per the share in the document, parent document. Or if you want to disclose it in only in the first payer's name and you have registered the property for the sake of convenience, then consistent stand should be taken. You cannot just move back and forth in disclosing the income. And foreign income or assets are very important to disclosure, because if non-disclosure may lead to penal consequences and it attracts huge penalty. HRA claimed by the tenant is also one of the very important common problem error that we are noticing in the recent times. Can you explain that?
HRA. If actually when the proofs are submitting to the employer, so they are submitting less proof to the employer. but at the time of filing taxpayer, so they are increasing the HRA. Even they don't know the consequences of the increasing HRA. For example, if the tenant is increasing, if taxpayer showing the HRA benefit is more than 50,000 per month is paying the rent to the owner, then he need to deduct the TDS also. So non-compliance of this, the income tax department, they will not allow this deduction and they will add back to the salary. So they will recalculate the taxable income. Accordingly, they will levy taxes and interest and penalty also. So misreporting, underreporting, everything it will come. So be careful when you are submitting the proof to the employer. So do the proper TDS if the rent payment is more than 50,000 and submit the necessary proof to the employer. So for avoiding these consequences from the income tax department.
Yeah. So we think that TDS is deductible only by the companies, and individuals do not have to deduct TDS. So this is something wrong understanding, because in the last 2 years, this is a very new provision where even if you are an individual, say from you are not a business, you are not running business, and you have not let out your property for any commercial use. You have not let it out to any office or any shop or anything. You have let it out to a professional who's working in a company, but still, since you have collected more than 50,000 rupees of rental per month, your tenant, though he's an employee, he's required to deduct TDS. He's required to deduct TDS against your PAN and then issue a TDS certificate. If he does not do that, the employee will get the notice from income tax department, and you will also end up in trouble, because we don't know whether it was your property, whether it was a joint property or whatever it is, rental agreement would have gone wrong. So please make sure that whoever is receiving more than 50,000 rupees of rent, the agreement is proper, agreement is in line with the original parent document. So these are some of the things, common errors they go wrong, common errors they commit in terms of choosing the wrong ITR, claiming ineligible deduction. This is something very, very serious. Just because the income tax return does not ask for proof, you cannot claim something which is not eligible. You have to be very prudent, take extra care when you are claiming any deduction. So whenever you are filing, claiming any deduction, keep the proof with you, either soft copy or hard copy, or any declaration in case of any gift or gift deed, you have it, so that tomorrow while disclosing, in case of any scrutiny, your return should stand on its own instead of calling for details. Even if they call for details, you should be in a position to submit. So if you do not submit in future because of wrong claim, you will end up paying huge penalty along with interest. So this is the care which you have to take care. And those who are crossing 50 lakhs of income, it is compulsory for you to disclose your assets and liabilities. So while disclosing the assets and liabilities, the department will be keeping a watch on whether you are disclosing all assets, what is the status of that asset, whether is it yielding any interest, that interest has been reported in your income tax return. All this cross verification is going to happen in the future. Currently it is collecting all the details, department is collecting all the details. Because of advent of AI and other things, it is just a matter of one click for the department to collate all the details relating to your PAN and map it with your income and issue a notice stating that you have failed to disclose. Any failure to disclose will amount to concealment as far as income taxes department is concerned. So these are some of the due dates which you have to keep in mind. As far as individuals are concerned, it is only 31st of July 2025 as of now. And if you see the trend of in the last 3 years, 4 years, I do not find any extension of time, because earlier, about 5-7 years ago, all assessees, they used to, used to be chill. Nothing will happen, madam. Department will last day only they will issue the notification for extension. But I'm very sorry, the last 3-4 years, absolutely no extension of any due date. So instead of waiting for the extension, let us be better complied by filing on time. So as far as the due dates are concerned, there are various due dates. So once when you miss the due date of 31st July, you think of next extension. Otherwise, don't plan for your extension. Then with this, we have come to the end of the session. Thank you so much for your patient listening. Yeah, if the floor is open now for questions. If you have any questions, anybody, please raise your hand.
Wow, that was a great session. I think we have one question, question and answer segment. It's, can you read? Can you see?
Yeah.
It is from Mr. Suresh G. So he has an issue with, in the
Q&A.
Q&A.
I have an issue with the pending taxes due from the
More than 10 years, unable to resolve this with the tax department. Now they want to deduct tax due from the current year returns. How to resolve old tax pending assessment with the returning officer? Yeah, Suresh, this is a very, very common problem, because in those years there was no, Form 26AS was in place. So it was whatever old demands were there, they were adjusting against the subsequent years refund also. You have to approach the department assessing officer.
You can approach the assessing officer and you can file with the correct income tax computation, so that they will nullify the demand and they will issue the refund also, whatever they adjusted till last year's.
I hope, Mr. Suresh sir, we have clarified your doubt. If you have more doubt, you can please reach out to us through our email.
Very.
So we have, with this, we have come to the end of the session.
Is there anyone who has any question to ask? We'll wait for some more time.
You can raise your hand.
Fine. Fine. Thank you all for joining us today. On behalf of Coral Metrics, I extend our heartfelt gratitude to each one of you who have insightful section on income tax. Special thanks to Chaitanya and Sadaji. Thank you for practical insights for truly help us prepare.
Thank you so much. Thank you. Thank you.
What was to- what was she?
Only 11, 18.
இல்ல 13.
30.